Our MSS Bonds. Latha Venkatesh is here to break it down for us. Latha, what are MSS Bonds? How different are they from the current scheme? And is it fair to peg the entire market's hope on these bonds?
Well, basically, MSS is the full form of Market Stabilization Scheme bonds. They are sold by the Reserve Bank purely to manage the liquidity in the system. For instance, in 2004, when there was a rush of dollars from 2004 up to 2007, India saw a lot of dollar flow, making the rupee very strong, and that will make our exporters uncompetitive and allow free entry of imports. So RBI started buying those dollars. When you buy the dollars, you're pushing a lot of rupees in the system, and that would be counter to your inflation policy. So you want to mop up the rupees as well. So RBI sells those bonds. And then, when market buys the bonds, they get the rupees, and RBI just locks up the rupees. Those rupees or those bonds are not part of the fiscal deficit. Normally, a Government of India bond, GSEC, is a loan of the government because it is not able to meet its expenses. But MSS bonds are not meant to meet the government expenses. They're totally a liquidity managing mechanism. Once the liquidity becomes normal, RBI sells back those pulls back those bonds and tries to normalize the liquidity. So it is only a liquidity smoothening bond. At the moment, the Reserve Bank is waiting for government nod for that, because again we have got the 7 lakh crore sloshing, and that might well become 10 lakh crore as more and more people start depositing their old currency with the various banks. And what do the banks do with all that cash? They have nowhere, nobody is borrowing at the moment. So they're going to the Reserve Bank and giving it in what is called the reverse repo window. That is, for 1 day you give it to the Reserve Bank. In exchange, the Reserve Bank gives you securities, and at the end of the day, it's reversed again. The money goes back. Now, RBI has only 7 lakh crore of bonds. What if the deposits with the banks start reaching, 8 lakh, 9 lakh crore? So RBI went with a giant CRR hike and took away 3.25 lakh crore. But that's an unfair thing to do, because as we heard Arundhati and others say, that's zero interest CRR. That's only for the time being. As soon as RBI gets permission from the government, government has to pay the interest. It's not the entire amount that they have to pay, but they have to pay the interest on the bond. So as soon as government approves that, RBI will start issuing the bonds called MSS bonds, and then the CRR can be rolled back, and 3 lakh crore or 4 lakh crore or whatever lakh crore of MSS bonds can be issued. They could be 90-day, they could be 60-day, they could be 180-day. We don't know, depending on RBI's view. They will issue those bonds and mop up all the liquidity from the banks. So, the banking shares have also recovered in the hope that the zero CRR will be replaced by an MSS, which will give them some interest rate, maybe 5%, 4.5%, something. The only negative will be for the existing Government of India bonds. When there are more bonds that banks can invest in, then the current Government of India bonds will take a little bit of competition. So, as you can see today, Government of India bond prices have fallen.
Okay, Latha, thanks for that. And sorry.